it's been a very interesting 6 months, not just for the business, but also for the broader environment, whether it's macro, whether it's policy. So talk to us about what a fresh approach means in practice for the business.
So for Cowen, it's really getting back to the things we do best. I mean, I think we are in a world that's really dominated by passive investing. I think we talk about this all the time, right? Half of every stock in the U.S. is owned by an ETF or a passive index. And so at Cowen, we're focused just on the half that's owned by active management. We try to focus on telling stories and making sure that people understand how to price assets, how to price financial assets. That's an element that has been excellent at Cowen for a long time, given research, given our banking efforts, given our sales efforts. So for us, it's really been about simpler, fewer, deeper, getting deeper in the segments we care most about and being able to provide that type of content so you can make great investment decisions.
Yeah. Still, as we look at the passive side, increase in influence, the rise of BlackRock, of Vanguard, of State Street, and these passive index giants, and retail investors shifting to those products as well. Talk a little bit about whether this transition to passive slows with the return, the seeming pickup in volatility.
So I think it could, but we're not counting on that. I think passive products have a really great spot for a lot of investors in their own portfolios.
So it's structural, not cyclical.
It's structural. I just think if you think about your own personal accounts, right, you have passive product in those accounts because someone has talked to you about how you can have a tactical asset allocation at the lowest possible cost.
Yes.
But there's still a lot of alpha to be had. And I think most of that alpha gets generated, frankly, by professional investors. And so what I see is a shift away from individual investors buying stocks. They're more focusing on passive and some active, where you have excellent managers who are actually outperforming. Hedge funds continue to do well. Some of them do. And so our goal is to figure out who those folks are and how we can align with them on a partnership basis to really help drive the return. So it's interesting. The street has always talked about, buy side and sell side as the line of demarcation. I actually think the line of demarcation is whether or not you care about active management and outperformance or you don't. And so for us, we're partnered primarily with those that care about active management and those organizations that are really trying to drive value by being better than average.
So he's picked his team, the active side.
Yes.
Well and truly. One of the big challenges of the restructuring, the reshaping of the industry was always going to be when volatility picked up and it tested the fabric of the market and how that has changed. Do you think that test has happened in what we've seen in terms of the pickup in volatility and the pullback actually that we've seen since February? So
I don't know that it's been tested. So everybody looks for analogs historically, and I actually think we're in a different type of environment than we've ever seen before. Although I think you could almost always say that. I think what's happened is the time frames have been compressed.
Yes.
And so market moves that we're seeing on a daily basis are ones that we used to see on a weekly or a monthly basis. And why is that? Because high-speed trading happens in nanoseconds and microseconds instead of seconds and minutes. And so if you extrapolate that, if you see 1%, 2%, 3% moves in a day, those might have taken place over an extended period of time historically, but they're now happening much more compressed because there's a lot of machines involved. There's a lot of people who are recognizing inflection points at a much more increasing speed. So has it been tested? I mean, I think if there is a massive panic, I think you're going to see a heck of a lot more correlation than we've seen historically, because when people withdraw money from equity funds don't pick winners and losers. They just pick everything. And so I'm not sure that that's been tested, but I do think that what we're seeing is a reflection of this more frequent, higher and faster trading that we've seen.
Well, speaking of the market environment, we also can't ignore the flattening yield curve. And we're going to leave aside whether this is a leading indicator of recession to the economists. Let them debate over it. Nevertheless, it does mean quite a bit for businesses, including yours. What kind of adjustments have you made or do you need to make to a flattening yield curve environment?
So we're certainly looking at, and we did this last year, we pushed out a bunch of financing for an extended period of time. We have a limited amount of debt on our balance sheet, not tremendous. We don't really use leverage to drive returns at Cowen. But we do have some borrowing, and so we've taken this opportunity in where the flattening of the yield curve environment, even before the rate increases, to ostensibly push out our borrowings. And I think if you're in corporate America and you have an opportunity to do that, now's a great time. I don't think that the long end of the curve stays where it is. I'm not saying that we're we're going to see a steepening or an inversion. Either way, I'm more sort of saying I think we're going to continue to see rates rise over the next, more likely to see rates rise over the next few years than not. And that's just a function of the fact that we're ending QE and Europe's ending QE, and people are going to try to get off of the stuff that was really put in place at the end of the last decade.
We've also had a whole load of fiscal policy chucked at the market at the back end of a cycle. We've also got changes as far as regulation or deregulation from this administration as well. What do you see that meaning for your business? Is it pure opportunity? Where are we?
So it's definitely helped with growth. I mean, I've been saying for a long time, this administration or whatever administration, I've been saying for a long time that, we can't really do anything with monetary policy until we get fiscal policy right. And I think that for a long time, the Fed was holding serve monetary policy, just making sure that the economy didn't roll over until we could get some sort of uniformity on how we were going to have a pro-growth agenda from our fiscal policy. So now we've seen a fiscal policy really step up. You're seeing the follow-through from the Fed on monetary policy where you're having it tighten and having the Fed reduce its balance sheet. So I think that makes a lot of sense. From a growth standpoint, I think anytime you're going at regulation and you're reducing regulation, it certainly helps. We've certainly seen, it's not just reducing regulation, but streamlining the administration. Certainly one of the businesses we're active in, which is biotechnology, Scott Gottlieb at the FDA has done an amazing job at streamlining the process for drug approvals. Right. Or streamlining, just decisions around drugs. And that's enabled capital to come into the business and say, listen, whether the science works or not, we know we have a clear path.
We can see the end game
Exactly.
here.
And that's been really, really helpful.